M&A TV is pleased once again to be joined by Marshall Sonenshine, Chairman of Sonenshine Partners. Marshall, always great to see you.
Nice to be with you.
Let's talk a little bit about your firm and what you do.
So our firm is an M&A boutique investment bank, meaning that we are purely advisory work, no capital. We don't write anybody's research reports. We don't trade anybody's securities. We don't lend anybody money. We don't make any investments. You could wonder what we actually do for a living. We give advice to senior management and boards of directors of companies, principally companies. We have some clients that are private equity, but more often than not, the private equity firm is a counterparty. Most of our business is representing companies that have need or desire to change something important relating to the mix of businesses that they own or the ways in which they are financing those businesses. So we're advisors to the CEO and the CEO's team and board.
And you are well respected and well seasoned, and you've been in the business for more than a couple of decades. Let's talk about the trends that you've seen, the motivations in cross-border deals right now in M&A.
Well, cross-border there's nothing new under the sun. Cross-border has been an important part of the investment banking and the merger and acquisition world for quite some time. I suppose if you went back far enough to the early 20th century, you weren't seeing a lot of cross-border activity. But on the other hand, you know, the great investments of the trading companies from East India to the South China Sea or whatever, they were all cross-border. There was a global world. Frankly, you know, in 1900 it was a global world. If you were a business person sitting in the UK, you were probably receiving cables and information and letters from people all over the world who were doing business for you. It was called the colonial empire. The global or cross-border world today is different. It is comprised of largely mature companies in Asia, Europe, Latin America, and the United States. Some of these companies are businesses that are acquisitive. Some of these companies are businesses that need to be acquired. Some of these companies are businesses that have particularly good technology or services and solutions that need to find new markets and need distribution. And some of these companies are already global and they need to be more global. The nature of what it means to be a globalization type world today is different from what it would have been or would have been said to have been in the 50s or in the 80s or in the 70s. This is different. We have a real economy in China, which until 1970 wasn't even available to us to talk to until 1971 when Henry Kissinger went over there. And until really the 1990s, there weren't companies that you would have wanted to have done deals with. And until the last decade, there weren't companies that you could have done deals with. Now you can. We have an ailing economy in Japan, but there are still amazingly robust, important corporations in Japan that matter. We have a checkerboard of activity and economic prospects in Europe. In the north, it's getting pretty good. It's getting better. The UK and Germany are healthy economies. I'd say the UK is a healthy economy, and Germany has been a very robust and strong manufacturing-based economy with some very good software, by the way, and services capabilities. In France, it's a mixed picture, and I'm not talking about the tragedy of last week. I'm talking about the difficulties of their corporate sector. There's pluses and minuses. And in Southern Europe, it's been a bit of a disaster for the last several years. So it's a very mixed picture. And then, of course, you have Central and Eastern Europe, which were released from several decades of communist rule and have turned out to be very good capitalists. And in Latin America, what used to be thought of as a continent that had outgrown boom-bust has not outgrown boom-bust at all. It's still the same old. It's boom-bust Latin America. We see it in Brazil now. We've seen it in Argentina. So the world is a complex place, and growth is a very mixed picture, and development is a always interesting picture, and development is strong in most of the major regions in the country, in the global economies, and so that creates opportunity all over the map for cross-border practitioners.
Do you mind if we get a little bit more specific now? You mentioned Asia. Let's go back to China with the volatility there. What are the opportunities or what are the concerns right now?
Well, let me start with two observations about China. Number one, I think their equity market is not a particularly cogent or leading indicator of the health of the economy. The economy was growing at very high single-digit rates during a long period of several years when the equity markets barely budged. And the equity markets took a nosedive earlier this year, particularly in August, and then snapped back in the fall, none of which I think is a particularly interesting indicator of the real economy in China. I think a lot of what goes on in the M&A, in the equity market is largely perceived now as a casino market. All equity markets have some elements of that because they are really about the supply and demand for stock, which isn't the same as the supply and demand for companies. It's different. So I think, number one, the equity market is not a particularly good indicator of what is happening. The bigger concern in China is that the growth statistics that it has shown and seen and displayed may not be continuing, they may not be sustainable, and now there are some concerns that the statistics of the country may not even be sufficiently transparent, i.e. we don't really know where growth is, we don't really know what growth is, and we also don't really know where debt is inside of the Chinese economy. We know that there is more debt within the provincial relations to each other and to the central government than was previously thought. We know that there are different claims within an economy that matter, but we don't know what the aggregate claims within the Chinese economy are. We also know that they've had a long history now, several years in the making, of overinvestment and underconsumption. Those are problems, structural problems in the economy that are worrisome. So I think China is a very mixed picture. On the other hand, you have state-owned enterprises that have become public companies with very substantial market caps, very substantial global ambitions, very substantial capabilities. They don't, some of them don't yet know how to do deals in the American and European market. They're putting toe in water and they're opening up dialogues, but they don't have a real history of doing deals. But they will. They are going to write that history over the next several years. It's not huge as a statistic. Outbound M&A from China is about $100 billion, which is about 2.5% of a $4 trillion global M&A market. Most of what is M&A in China is domestic M&A, which is not the stuff that most American and European practitioners are likely to be working on. That said, the 100 billion or so that is Chinese outbound cross-border M&A today, this year, will probably be 200 billion within a year or two, and then it'll be 400 billion. It will continue to grow, and it will become a more and more significant component. Whatever happens in the economy, those companies are going to work, and they're going to expand. That you can pretty much set your watch by, but I think there's a lot of uncertainties about what is going to happen in that economy.
Okay, now what about Japan going into its fourth recession in 5 years?
Yeah, I know. It used to be said that American economists have predicted 7 of the last 4 recessions, but nobody has predicted enough recessions for Japan. It's tragic. Look, I think that Japan is a very confusing picture. The problems structurally inside the Japanese economy for some years now, really for the better part of 2 decades, has been an inflated social safety net, which is too expensive for the economy to sustain, and a certain insularity to the way business is run and organized within corporations in Japan, despite the fact that the most important Japanese companies really are very global companies. They are multinationals that matter. The flagship companies, whether it's Mitsubishi or Sony or Hitachi, or any of them, Sumitomo Group, these are all very global companies. And yet if you look inside, they are very entrenched in older world forms of doing business. They are who they are. Their boards of directors, despite how global they are, their boards of directors are all Japanese. Most of their management team is substantially Japanese. Even Lixil, which is a great example of a global manufacturer, one of the biggest manufacturers of components for household building. They have a GE trained CEO. Don't get excited, he's Japanese. Nothing really has changed in those companies internally. Externally, they are very different and very vibrant organizations. So it's a confusing picture. These are important companies. Suntory is a great acquirer of companies all around the world. These are very important companies. They are sometimes held back by cultural forces on the corporate governance and cultural side and government side that has made it more difficult for them to thrive than their competitors in the United States and Europe. So look, Japan is still bigger in terms of cross-border M&A than China, but not by much. China will probably surpass it in the next couple of years. I don't think this is an arms race for how many cross-border deals you do, but I think that the Chinese are trying hard to be active players on the global scene, and the Japanese have long been active players on the global scene, but are being held back, and the Chinese are being pushed forward. We'll see. Japanese companies are much more developed, clearly. I mean, they have decades of very successful capitalist evolution. China, everything is new.
And looking at different sectors, any sectors that you think are standing out right now as far as advantages and investment possibilities, the biggest sectors?
Well, if you start with China, historically, outbound investment was largely basic materials and infrastructure, mining, energy, the big stuff. Today, it's more about services, and that includes software, includes solutions, and includes consumer, and includes technology. So you're going to see companies that are now very, very large corporations, like JD.com, which is an e-commerce or internet player, or Alibaba. You're going to see them making acquisitions. These are very potent forces with very, very large market caps. So the big transition there, I think, is from basic to diversified economy, which is the story inside the economy. It is the main driver of Chinese business today, is a clear mandate from Beijing, an economic policy towards urbanization and conversion of the economy from basic manufacturing to diversified services. So you're seeing that play out in the expression of M&A. In Japan, I think you will see another round of cross-border M&A from the majors. I think you may start to see something very different in Japan, and that is Japanese companies selling themselves. We have not seen very much of that historically. We may start to see it now.
Interesting. Always great insight. Marshall, thank you so much for joining us on MD TV.
Good.